apparently there's a panic to buy physical gold out there for sovereign wealth funds and also central banks. They're concerned that there will be a failure to deliver through the derivatives market, be that the COMEX or the LBMA. You might not agree with me. You might say LBMA is a physical market, but not 100%. It's a promissory note. It's a derivative, for OTC derivative. That's what it is. It's a forwards market mainly. So yes, we've seen a lot of volatility in gold, especially in silver. We've fallen back below 30 in silver. Gold just held above 3,000.
MarioInnecco, the voice behind the popular YouTube channel MoneyInnecco64, recently shared his thoughts on the state of the financial system, gold and silver, and why Exter's inverted pyramid remains so crucial to understanding current economic risks. Mario, a seasoned economist and sound money advocate, believes that as the fiat-based financial system deteriorates, liquidity will inevitably flow to the base of the pyramid, physical gold and silver. He explained that fiat currencies and paper assets, like government bonds, T-bills, and derivatives, sit atop the pyramid and are most vulnerable during crises. In contrast, physical gold and silver, which carry no counterparty risk, sit at the bottom, offering proper security. According to Mario, gold ETFs, COMEX contracts, and LBMA notes are not indeed safe haven assets. They're paper promises, not actual ownership, including a friend who runs a family office in the Bahamas, report panic buying from sovereign wealth funds and central banks. The fear? A possible failure to deliver physical metal through derivatives markets like COMEX or LBMA. This has driven premiums on physical bullion higher and created significant delivery delays. Mario also recalled the March 2020 crash, when gold dropped sharply from $1,700 to $1,450 and silver fell from $18 to $12. He warned that similar volatility could return. Interestingly, while silver recently dropped below $30, gold has managed to hold above $3,000, even reaching $3,130 at one point. Mario urges his viewers to hold on to your gold and silver for dear life through this turbulence. Long-term, gold has broken out of its consolidation phase against the US dollar and 10-year Treasury bonds, which he sees as highly bullish. He's also watching the Dow-to-gold ratio closely, predicting that one day you'll be able to buy the entire Dow Jones Index with just 1 ounce of gold. In short, the trend favors precious metals over fiat and paper assets in the years ahead. We present the latest clips of MarioInnecco's video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
And one of the reasons he brought up this inverted pyramid is because, in his opinion, when this I owe you nothing fiat dollar imploded, when the whole system collapsed, all the liquidity would flow to the bottom of the pyramid where gold and silver are. Yes, there's a lot to flow through government bonds, treasury bills, and even paper money, but ultimately gold and silver are the only parts of the pyramid that will stand because there's no counterparty risk to them. Of course, that's only if you hold physical gold and silver, paper assets in gold and silver ETFs, and anything else, LBMA allocated promissory notes, COMEX, they're all at the top of the pyramid, actually. They are derivatives. So that's why we see this volatility in the price of gold and silver. But if you try to go out there and buy real physical gold and silver in quantity, there's going to be a delay and the premiums are starting to move higher. That's what I've heard from a good source, a good friend of mine who runs actually a family office in the Bahamas. He's been hearing, and he works a lot with the gold sector, mining, physical gold, and apparently there's a panic to buy physical gold out there for sovereign wealth funds and also central banks. They're concerned that there will be a failure to deliver through the derivatives market, be that the COMEX or the LBMA. You might not agree with me. You might say LBMA is a physical market, but not 100%. It's a promissory note. It's a derivative, for OTC derivative. That's what it is. It's a forwards market mainly. So yes, we've seen a lot of volatility in gold, especially in silver. We've fallen back below 30 in silver. Gold just held above 3,000 recently. I think it was yesterday or today. He said in March 2020, gold dumped from around 1,600, and actually it was actually just above 1,700 that gold dumped from to 1,450. So it was more than a 10% drop. And that's when all hell was breaking loose. Of course, in March 2020, the stock market dropped like over 30%, I think, in a week. But he knows that a lot of the miners dumped 80%. So the miners, even though they have come off, they haven't dumped 80%. So he says in today's term, that would be the equivalent of gold dumping to 2,800 with miners devastated. Of course, that hasn't happened. And he says, I think silver dumped from 18 to 12. Yeah, around 18, 20 to 12 back in March 2020. That would have been equivalent of silver dumping to around 23 in today's term. So yes, a lot of people over the years worry about these events where there's a stock market crash, whether gold and silver are going to crash along with it. Yeah, and they do. And yesterday gold, spot gold got up to like 31.30. It did finish, I think, around 30.35. I'm not sure what the closing price was. What I'm trying to say here is, and I've said this many times, I have a series of videos. It might even be a playlist. I don't remember. That you need to hold on to your gold and silver for dear life. And the reason I say that is because of Exter's pyramid.
MarioInnecco pointed out that despite recent price drops, gold and silver are still in strong long-term uptrends. He referenced Exter's pyramid to emphasize that physical precious metals are the ultimate safe haven. Gold has recently maintained levels above $3,000, while silver briefly dipped below $30. Mario warned investors not to be fooled by the volatility in paper markets. COMEX and LBMA gold or silver positions are ultimately derivatives, not tangible assets. A growing number of sovereign wealth funds and central banks are racing to acquire physical bullion. He further highlighted how miners, although affected, have not yet seen the catastrophic 80% drops seen in March 2020. If a deeper correction hits, this may signal more downside to come. Amid all this, he encourages people to continue stacking physical gold and silver, not ETFs, and pay attention to long-term ratios like Dow to gold and gold to treasuries, both of which favor further gains in metals. Let's get back to the interview.
Since the beginning of the century, gold has been in a bull market versus treasuries. Gold has been the place to be. Yes, we had a long consolidation from 2011 up until last year in 2024, when gold broke out not just versus the dollar, but versus 10-year dollar, you could call it. And that's all it is. And yes, gold has dropped back a little bit this week versus the 10-year treasury, but you can see the trend is higher, and the breakout of this consolidation is very bullish, just like the price of gold breaking out last year has been very bullish, and I think that's going to continue. The other gold ratio I wanted to show you is the Dow gold ratio, and I think that's another very important ratio. Royalty company, I agree with him. He says this ratio will go back to 1-to-1. I don't know at what price, but it will mean that you'll be able to buy one Dow Jones Industrial Average Index for 1 ounce of gold. And as you can see here, this is a weekly chart, and we closed on the lows of the week. So the Dow crashed versus gold as well. and it's very close to the low that we saw actually in March 2020, despite the correction in gold that we saw back in 2020. Gold, the Dow actually crashed even more. So that's what I'm trying to show you here. It's all relative, and I think the trends, as you've seen from these last two charts, the gold versus constant maturity 10-year treasury and Dow versus gold, those trends are set. They are set here now. I think, yeah, gold is going to continue to outperform the stock market and the bond market. Yes, there's going to be corrections along the way, but the long-term trend is definitely set in the advantage of gold and silver as well. I know the gold-silver ratio went up above 100 yesterday, but I would say that's just another opportunity to buy physical silver, not ETFs, of course.
To wrap up, MarioInnecco of MarioInnecco64 makes a compelling case for why physical gold and silver remain the most resilient assets in the financial system. With growing instability in fiat currencies and derivative-based markets, he argues that the long-term trend favors tangible wealth. Despite recent pullbacks, gold has maintained a strong position above $3,000, and silver, while more volatile, remains a strategic buy, significantly as the gold-silver ratio spikes above 100. According to Mario, these dips are opportunities, not red flags. His advice is clear: avoid paper promises and hold on to your gold and silver for dear life. Investors should prepare for continued volatility, but also trust in the long-term trajectory of precious metals. If you're concerned about market fragility, now's the time to stack tangible assets. That's it for today. Share your thoughts on MarioInnecco's analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.